The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
And welcome to Your Money, Your Call. It's bonds versus equities. My name is Mark Todd from FIIG Securities. If you have any questions at all about the bond market, please give us a call. We'll even talk about the share market. 1300 30 34 35, or you can email us yourmoney@skynews.com.au. And tonight it's the Chris and Chris show. We've got Chris Alcott from Mason Stevens and Chris Cuff. Chris, the company director. He is the chairman of Cufflinks and Third Link executive. He has many hats to wear. Gentlemen, welcome. How are you?
Thank you, Mark.
Hi, Mark.
Had a good day so far?
Had a good day.
Better than Cronulla. It's been a tough day for the Cronulla
Probably
Sharks.
better than it is down south, yeah.
It is. Look, let's start with the discussion. The theme of the show is all about the education. It's about trying to talk to the viewers around how markets have evolved, how options are now available, where previously you'd taken a fund manager's perspective or a stockbroker or whatever it might be. And it's all about the education. So I would like to start with you, Chris, about the education piece and the venture that you're now running, which is one of the many ventures, is Cufflinks, which is a great name. I thought of Mark Todd or Marked Up or Todd Links. It doesn't work. So what a terrific name. If you've got the slide to bring up on Chris's website, we can talk about what's happening on that website. And so if you can give me some sense of Cufflinks, what's the goal and how do you get people to contribute? Because there have been some great names.
Sure. Well, Cufflinks is a weekly newsletter that myself and three other colleagues decided we'd put together, and it's in its 5th week of operation, so it's fairly early in the piece.
Yep. And
it's designed as an educational forum, so it's an independent forum. That's the most important thing, which is about connecting industry professionals with engaged investors and other professionals. So it's all about sharing ideas, but in again a very independent way. So it's a subscription-free, no product advertising, no product placement, so it's free from the commercial biases. And we don't, the newsletter isn't about talking about current affairs or which stock's going up or down. It's value-added stories of education in the investment industry, again, written by professionals.
Yeah, it seems like a great idea, doesn't it?
Absolutely.
It's independent, non-sales focused. I guess it's one of the things that when you talk to your clients, you need to point them to these sorts of directions, don't you? Just say, look, I think you should be having a balanced portfolio and I think this is what's balanced. Mm-hmm. And then natural perspective, because it's the GFC, the effect of the GFC is, I like you, Chris, but I don't know if I can trust you all the way with my money. Mm-hmm. And you can point to those sorts of websites, and we might give the link to it, Chris. It's CUFFE links, links.com.au. And you point to that website and you'll have Paul Keating writing an article on his view on longevity or the superannuation.
Yeah, as I say, it's written by practitioners, and we're 5 editions into it, some of our early writers. Paul Keating's written 3 articles for it. Jeremy Cooper of the Cooper Review has written an article. We've had Don Stammer, who's a well-known columnist, write for us. We've had senior demographers, investment managers. So it's quite influential people who know their trade well and have been round the block a few times, have a bit of grey hair.
It's a grey-haired publication, isn't it?
Yeah, and they're happy to share their views. They're not long articles, they're sort of punchy articles, again, of value that we think people would read and say, oh, I didn't know that, or you explained it very easily.
Right. What about Mason Stevens? I think of you in the same way. How do you provide that education piece to your clients? What are you doing to try and get them up the curve?
I think education is key, knowledge is power. I think if you can continually inform clients and investors, you're going to get a better outcome over a longer period of time. So The way that we approach it is generally we would talk to our financial planning clients and take them down the process of understanding things perhaps they hadn't been exposed to before. And a good example in our case has been residential mortgage-backed securities, where we started an education process some 12, 18 months ago.
Yep.
And we've seen the benefits of that, and clients have had a very positive experience.
Fantastic. Now we've got a caller in. It's Trevor from Perth who's calling in, so it's nice and early for Trevor. Trevor, how can we help you?
Oh, yes. Good evening, panel. I just wondered if you could give me some advice on the National Australia Bank convertible preference share issue, and then particularly possibly what they mean when they say it's a bank bill rate plus the margin adjusted for the NAB tax rate. I'd appreciate your help there. Thanks.
I wouldn't want to offer a thought that they're trying to confuse you, because I know they're not, but they're trying to protect you from yourself to some extent. The National Australia Bank and Westpac have both issued similar sort of convertible preference shares. Around about 3.2% is the rate you're expecting to receive over the bank bill swap rate. So the bank bill swap rate is the rate at which the banks can borrow money from each other on a regular basis, and it'll be from 1 month out to 6 months. Your margin will be on the 90-day bank bill, and it should be 3.2 after you've used up the franking benefits that the NAB is providing you. In terms of its worth to you as an investor, you know, we personally think there's better options around at the moment. We spoke about this last week. But in terms of a fixed income asset, it's a fairly conservative asset, to be honest. You do end up with the National Australia Bank shares in the event that the bank itself doesn't perform and some liquidity problems with the bank. You'll end up with shares in that respect. But, you know, those sorts of things are probably, there's riskier options around, and this is probably in the middle of the more conservative option. And without speaking directly to those, I mean, that's the hybrid world, isn't it? It's an easy thing for people to sell. And it's going through the stockbrokers in billions of dollars. I mean, it's...
Yeah, I mean, you get, you know, using the franking credits means you'll get a cash coupon of something just under 5%. And then when you add the franking credits on top of that, you'll get to that 3.2% over the bank bill rate. So you're looking at a grossed up return of about 6.2% when you include those franking benefits.
And clearly with hybrids, the thing about the hybrids, and the regulator likes to point to that, it says these are riskier than some other assets, and the regulator, the trick for the regulator is trying to explain that in simple forms to people. And again, it comes back to that education. Where am I in the capital structure? And most people don't even think about the capital structure. It's just that's NAB.
Well,
they're all the same.
And the point, I think also that the NAB and the major banks and all of the issuers have performed for issuing this type of security for a long period of time. So I think the name and also the history gives people comfort.
Callers are happening all the time at the moment. We have Chandra from Newcastle. Hello, Chandra. How can we help you?
Oh, hi. My question is, what does the panel think on Preco bonds? That's P-R-A-E-C-O.
Chandra, it's a good question. It's timing, and I don't know, Chandra. I promise you I don't, because I'm about to talk about Preco in the next ad break. Preco is the Defence Housing Building. It's in Canberra. You know, I like, without speaking specifically to the Preco, because I will be talking about it, but in this call, other than the fact that we like public-private partnerships, and I like the idea of buying the Defence Housing Building. I like the security that these sort of things offer. You're going to take the government receipts. You'll get, you know, the numbers on Preco at the moment. I think I had a number here on Preco. You'll get a yield and maturity of about 6%. So I like all those public-private partnerships that are very small issues. The big guys can't come in and crowd them out, and they're available to people in $50,000 denominations. So Chandra, to that end, we do like the bond. We think it's quite an attractive option. I don't know, are you familiar with any of those bonds?
I can't add to that, but I do own it. Right. I'm a client of FIIG's as well, and I do like it for the same reasons you just said there.
Yeah, it's a very simple structure. And I like simple. I mean, I'm of the Buffett mould. You know, you buy a business that an idiot can run, because eventually one will. You know, I think the same way with my investments. If I can understand it, it needs to be pretty simple.
Absolutely.
Now, gentlemen, we won't get held up with all these phone calls, which is fantastic. Let's talk about business with you guys. You know, Mason Stevens is going pretty well at the moment. You know,
We
it's
are.
got the right sort of mix, hasn't it?
We are. I mean, we've seen an equity market that's, you know, added 1,000 points in a very short period of time. We've seen credit spreads come in, and we've seen an accelerated amount of deal flow. And luckily, we are able to access across the spectrum, you know, most of those issues for our clients, and give them our view as to whether they're appropriate for their portfolios or not.
Are you seeing, and we've got an email that we'll go to in a minute, but are you seeing the level of interest in the franking, the whole idea? Because I want to lead to Chris in a second about the idea around franking, but are you seeing it from your clients? I must get into these because of the franking options available in shares. Is that
Certainly it's a consideration, definitely. I think most clients understand the benefits of franking, particularly if it's in their superannuation fund. Certainly, yeah, there's some demand that is driven by the level of franking that they can achieve in some of these instruments.
So, Chris, you were putting some on cufflinks. You were putting an article about franking, which I thought was very interesting. So, can you talk me through, you know, how you articulated the franking in people's portfolios?
Yeah, well, the basic thing I wanted to show with a formula is what level of shares do you need, Australian shares paying franked dividends, would you need in a superannuation fund to have your tax rate at 0? And it wasn't saying franking was good or bad, but it's just what amount do you need to get there. And I made some assumptions at the time which have changed a touch, but I said if you had franked dividends grossed up at 6%, and your other investments, say term deposits or cash or whatever, might have been earning 4%, then that said you needed around just over 30% in shares to have a 0 tax rate. So I provided a formula that you can use at any time, and it really just, I think, really rams home again how valuable franking credits are. And franking credits are actually worth more than the market gives them value for, because we have a lot of foreign investors in the Australian share market, and foreign investors can't get the benefit of franking credits, so there's always a little bit of value left on the table. And the other thing I always like about a company that has franked dividends is it's paid tax, and you know, paying tax means it had real earnings. So that's sometimes it gives you a fair bit of comfort.
Because we spoke about this, didn't we, when we were having coffee, about the idea that people were providing dividends on things they hadn't had earnings on. They just had, the valuation had increased, and as a consequence they said, oh, you know, here's some dividends, and there were certain infrastructure trades that can't exist nowadays, can they?
Exactly. You know, a real smoke and mirrors trick of some organisations which came undone a lot was in the infrastructure area, where they were revaluing assets and saying the revaluation reserve was then used to, if you like, pay out distributions, but the distributions were a sort of tax-deferred distribution. They weren't representative of cash flow, and ultimately those things came undone, and those particular stocks having that had big falls.
And it's interesting, it took a while, because they could do that for quite a long period of time. They could defer the implications of what was happening in their performance. And it's just, I felt the GFC was unique in that it all came apart everywhere on the same day.
Yeah, exactly.
It was the same sort of affair, wasn't it? I was working in the United States at the time. It was happening here, it was happening everywhere. And it was quite interesting, because normally there's got that rhythm to it, that you lose economic behaviour out of your counterpart and then you try and get it internally. That didn't happen with this, did it? It was all bang, one day gone.
No, it was a very cleansing type approach. But, you know, the key again with any distributions, dividends, whatever, I'd always look to see that the cash flow has been earned first before a company is paying it out. And then if they've paid tax on it and that's giving rise to franking credits, that's terrific. And we know, you know, companies pay tax at 30%, so the franking credit you get in a super fund is sort of a double whammy, because you're only paying tax at 15 and getting a credit for 30.
Yep. Look, we'll have an email here at the moment. This one comes from Henry in Bendigo, and Henry asks, and this is again, you know, considered, if I get 7% fully franked on Telstra shares, why would I ever buy bonds? Chris Olcott, would you care to answer that one? Or?
Okay, I think certainly if you look at Telstra as a stock, it's performed very well, and it's picked up, the share price has picked up, and certainly it has sustainability of dividends and paid tax, and you do get the benefit of that franking. But when you're looking at comparing one asset class to another, I'm reminded of Qantas when it was bid for before the GFC by a consortium, and it was bid for, I think, at about $6 a share. It was trading at about $3 before that. And I remember someone posing or objecting to selling their shares to the consortium because they were going to give up their fully franked dividend. Now, with no disrespect to that investor or to what happened, and certainly circumstances changed quite adversely for Qantas. Qantas hasn't paid a dividend for 3 years. So I illustrate that probably just to suggest that things may well go well for Telstra in the future, and certainly I hope they do. But looking at a share versus a bond and the dividend, I think you need to take into account other things.
I agree. I hope they do as well because I own them. But if the three amigos came back into town and took over, you know, that volatility in that bottom part of the curve becomes very difficult. You know, if you only buy for the franking, all of a sudden you get the... Now you, excuse me, you bought into a management that may not necessarily be the management you want, so that always makes it a bit tricky for me. So I don't think you don't buy Telstra. I think you buy a bit of both. I think you buy a combination. Now look, we'll go to a break. We'll have a very short break, but please call us on 1300 30 34 35 or email us, and the email is yourmoney@skynews.com.au. We'll be right back.
I'm looking for a provider who gives me everything I need to trade Forex in one place.
I want customizable charts developed for Forex traders, transparent prices and a stable platform.
I want a provider that presents me with Forex trading opportunities 24 hours a day.
That's why I trade Forex with IG, Australia's #1 Forex provider.
It's time to free ourselves from harsh cleaners, overpowering smell and nasty chemical residue. Free ourselves from worrying about the ones we love. Dettol Power and Pure for a powerful yet healthy clean. Its unique active oxygen formula cuts through tough stains. It leaves no harsh chemical residue and kills 99.9% of germs. Powerful cleaning that's family friendly. Now also available as wipes.
At Sage, we have over 6 million customers, and that makes us a leading global supplier of business management solutions for companies with up to 1,000 employees. Like Sage ERP X3, our global solution for larger businesses, with almost 4,000 customers in 58 countries worldwide, deployable on-premise or in the cloud. With credentials like these, we must be doing something right. So call us on 13 Sage.
Welcome back to Your Money, Your Call, the Chris and Chris Show. Tonight I'm joined by Chris Alcott from Mason Stevens and Chris Cuff. Chris has many hats to wear, but we're talking firstly about cufflinks. We'll talk about Third Link soon, so it's a great opportunity to get all the business out today. So if you have any questions for us, 1300 30 34 35, or you can email us yourmoney@skynews.com.au. We talked about Telstra prior to the break. I want to talk about the idea of the cult of equities. I think it's interesting. Everyone is focused on the equity market, and it's not just because of the rally. They've just built an inherent understanding of the equity market. I suppose that's our education piece. And I was talking to a client today. He is a planner. He'd advised customers, I think it was about $1 million portfolio each, that this is the bond portfolio he wanted them to invest in. He thought that was in their best interest. They were older people. They thought they could get consistency of earnings. And both customers said, you have to buy equities. They're going. I've got to get on that horse. And he was frustrated. He said, I'm the planner. They're not taking my advice. You know, what do you think I should do? I don't have any idea. You just don't have the relationship. But Chris, what do you think about it? It's created a great opportunity for everyone. The equity market, it's a great thing, but what do you think of this cult of equities?
Well, you know, equity markets are a great place to be invested when things are working well, and they cause panic in the streets when they reverse. I think probably the issue for Australians, if you look in superannuation funds, it's often said in the media the typical superannuation fund, a balanced option or whatever, has a large amount of equities in it compared to similar funds offshore. So we might have 50, 60, 70% equities, and offshore would be maybe a much lower number in the US or Europe or whatever. But I think we have a whole generation that grew up in a strong equity market. I mean, apart from the last 5 years, Australia experienced 2 decades basically of rising equity prices. So it's not hard to understand why people feel they must have it. You know, when things don't go as well, you touch wood, you've got a diversified portfolio.
That's right.
Something else in it.
A truly diversified. I've got the CBA that I've put up here. It's a chart. And what this shows is the top line is the CBA senior debt. Again, we talk about the capital structure. And you can see that the top line, the green line, just consistently performs. This is through the GFC. Now, I don't think you have a GFC every Monday, but it is important to understand how the portfolio behaves when you do have a GFC. Pearl's 6, I think it is the other one, and then the equity, you can see the movement of the equity down the bottom. Now, it's not to say that CBA isn't good equity, and it's not to say that you shouldn't buy one or the other. I think you should buy a combination of all. But you can imagine down the bottom there, at the bottom of this, Chris, that would have been very stressful around that period of time where you see the equity market if you're only in the equities. It would have been very hard on the sleep patterns.
Well, I think you make a good point. I think you need to distinguish between good companies and what you're prepared to pay for those companies. And you need to take into account the information that's at hand at that point in time. And at that point in time, CBA had raised money, that sector you point out there, had raised money to take over Bank West and was under some sort of duress in order to take that out. Ultimately, that was the perfect time to buy the stock. But when you're comparing the stock versus the bond, timing is a lot more important when you look at purchasing equities. That company itself is outstanding and has been for a long period of time.
That was that failed raising, wasn't it? Where with I think it was Merrill's and UBS. I'm not sure which, and I don't think Merrill's are so happy with CBA anymore. I don't know how that all played out, but I remember there was they'll work it out over time. But I think there was a mistake around the pricing and the amount of disclosure. So. But again, everyone's under stress at that point in time, and you don't necessarily want to be party to that stress. You want to be in a more comfortable spot. If you're in your 20s, have the stress. That's great. But if you're in your 60s, 70s, I think you want to be working on golf. I don't know you need that.
Well, I was going to say too, at some stage we'll show in our newsletter, there are long periods in history where equities underperform bonds to start with. And despite equities going up during some periods, it's often in high inflation periods too in the past. And if you look at the real returns, they can be quite disappointing. So, many people say be in equities long term and you'll always do well. I think it's a lot to do with timing and what's going on with inflation and other factors. If you turn the clock back, I think, to the 40s, 50s, whatever, we went through very, very long periods where equities did nothing or went backwards for 10, 20 years. And so no wonder, as I said before, many people have been through 2 decades of bull market equities. Go through 2 decades of bear market and see how you feel at the other side of that.
That's right. And I think to some extent, and I want to talk to you about what the planners are saying to you, it is that wall of money that comes through. And the comfort around buying equities because you've got so much money to spend. I mean, how are the planners reacting to... I think you're trying to change their behaviour to some extent. Here are different options. Here are the things that are available. How are they warming to that argument? Is it working for you guys?
Look, I think they are. I think what they're intending to do is add value to their clients, and that's got to be the starting point. So what you need to do is, you said on education, is... continue to educate, continue to get more information and grow your knowledge base. So certainly the big issue that I think planners are facing at the moment is clients wanting to switch out of term deposits, which is the lowest of risks, straight into the equity market, which is the highest of risks, and trying to balance that process and keep some sort of defensive strategic exposure to cash and shorter-term securities, I think, is a challenge they're facing.
I mean, that's the great rotation, isn't it? It's not the rotation out of fixed income into equities, it's the rotation out of the cash, where the banks don't need the money for an array of different reasons, into the equity market because you're comfortable. You gave the money at the very top of the curve to CBA and think, oh, well, they only give me 3% now, I might as well buy their shares, and I think that's what's happening. Chris, can we talk about Third Link? Tell me about Third Link.
Yeah, it's another one of my activities. So I manage an Australian equities fund, an Australian share fund called Third Link Growth Fund, and I run that as a fund of funds. So people charge me to look after their money, and I invest it with other fund managers who I judge are very good Australian equity managers. And what makes this product quite unusual is that all the fees, the management fees earned, are donated to charity. So this is an equity fund that has provided very good investor returns. It's on the shown on the website, thirdlink.com.au. So the investors have got good returns, and we, through this fund, now distribute over 60,000 per month to a range of children's charities.
Oh,
so it's one of those win-win type situations. Investors are getting good funds management and the returns that go with that, and charities benefiting from the management fees. So it's a great community effort.
We'll talk about that a bit more, but we've got a caller, Henry from Melbourne, calling. How are you, Henry?
Not too bad. How are you?
Pretty good, thanks.
I'm interested. So there aren't nearly as many issuers of Australian corporate bonds than there are of equities. Is there a reason for that? And separately, does that mean that I can't get sort of the same diversification as I can in an equity portfolio?
Do you want to hand over, or should I take this one?
No, I think that's a very good question, actually, and I think what you've seen in Australia is a less mature market than what you've seen certainly in the United States. What we do have, though, is quite a large bond market, as you're well aware, Mark, and I think the issue is more trying to understand who are the issuers. There are names that are household names, the Wesfarmers, Woolworths, Telstra, the banks, obviously. There is a very, very deep market, but there is that issue of diversification. The only thing that I would say about that in relation to the equity market is the equity market is actually, the index is dominated by really 20 stocks domestically. The index weighting is heavily dominated by the financials, BHP, Rio, Woolies, Wesfarmers. So there is some diversification that you can get certainly going outside that, but in terms of an index weighting, there's quite a big concentration risk in the Australian market, and I think doing some digging to find out who are the other corporates that issue, how they issue, and the sort of instruments you're going to talk about soon, it's just trying to understand what's out there.
What about you, Chris, in terms of this question?
Mark, you're probably better qualified than me, but my observation would be, relative to the equity markets, that hybrid market, as we call it, is a lot thinner, but it has expanded very considerably in the last 5 years. So we've seen a lot more issues come to market, a lot more names, but it's still relatively, I think it's relatively sparse compared to the equity markets. But the point that Chris made was, but our equity markets are dominated by just a few stocks as well. The other thing I think is it's been harder to bring issues to market because of all the regulation that goes with it, and the government's, I think, has been trying to make that easier, more accessible so corporates can do issues.
I think that's right. I think it'll be inevitable. I mean, clearly within FIIG you can create portfolios, you can get diversity in the array of direct bonds that we have, and there's hundreds. It's a very big array. But Henry, and it's not the Henry from Melbourne, but Ken Henry was saying that there aren't enough bonds. You need to have more bonds in your portfolio. And the government has taken that on board, and I think they will, over time, through the disclosure rules and some of the amendments to the Corporation Act, will make it very easy for companies to come to the market and give what both the regulator and the people know they want, which is consistency of earnings. So the point is, Henry, you can get some diversity through that equity market. You are in the riskier part of the curve. You can come to other people like FIIG and the like. I think JB Weir offers some stuff, and get portfolios that will give you some of that diversity you need. But it will be an expanding corporate market. There's no doubt in my mind.
I think that's important. It will continue to expand. A lot of corporates were hurt or stroke disillusioned during the GFC with the banks, the way they became very tight on their lending. So this is a market that is an alternative to go rather than just put everything with the bank.
Yeah, absolutely. We've got to get away from the banks as much as we can. You know what they're like. They can't have all of it. Now, we'll be heading up to a speed round. I've got 30 seconds, and my bond of the week will be a portfolio rather than just the individual bond. My time starts now. So what I'm looking for is in infrastructure assets. We spoke about Preco. I like the look of Preco. I like GEM. I like Dalrymple Bay, and Southern Cross Airports for some inflation kickers. And what I'm looking for in these assets are investments over 5 to 5.5%. I want a real return of around about 6%, and I think those sort of assets form the benchmark of what would have been my TD portfolio. To give me 6% on some safe assets seems like a very good investment to me.
At Nissan, the big one is back. We were first with 1% finance, and now it's back with 1% comparison rate across the Nissan range. We even put it on the all-new Nissan Pulsar. Get into your Nissan dealer by March 31, leave it.
That could be a simple mistake. Or a deliberate move for a long-term advantage.
Perhaps.
But no, you're someone who plans ahead. I'm thinking you don't make a move unless you've thought things through. And if you don't have an answer, you'll find someone who does.
ANZ Wealth Managers can help you make the right moves to achieve your long-term goals.
Nice move.
Australia, you need a break. And with these great low fares from Jetstar, now's the perfect time to take one. Take off from Melbourne Tullamarine to Launceston from $59 and Sydney from just $65. Or take off from Sydney to Launceston from $89 and Darwin from just $179. There's a one-way check baggage not included that may be added for an additional fee. Not available on all flights or days. Conditions apply.
For details and to book, visit jetstar.com.
There are lots of different types of pain, like back pain and headaches, for instance. So not surprisingly, pain relief isn't a one-size-fits-all. That's why Heron offers different relief for different pain. Heron Blue Ibuprofen is for inflammatory pain, like sprains and strains and back pain. And for many people, Heron Gold Paracetamol is for headaches and everyday aches and pains, and is gentle on your stomach. Heron Gold and Heron Blue. Know your pain, know your relief.
What's the most complete all-in-one parasite protection? Advocate. It kills fleas even before they bite. It protects pets against worms, and it's water resistant. Advocate. Now that's advanced pet care.
Welcome back to Your Money, Your Call. It's the Friday edition of Bonds versus Equities, and we have Peter on the line from Sydney. Hello, Peter.
Oh, hi. Thanks for taking my call. Look, I deal with Westpac Securities, and they're advertising an issue by HealthScope, which seems to be paying a very high rate of interest, which would normally put me off. I think it's something like 10%. Do you have any comment on that?
I think HealthScope was one of those things that were, I'd call it a freak of nature. The issue was open and closed in one day. So if Westpac has some and they're looking to sell it to you, putting aside the value of HealthScope for 1 second, the case against HealthScope will be that it's part of an IPO, ultimate an IPO. So the equity markets need to rally, and that would make it very attractive. The market, the professional market, has bought that with their ears pinned back. They like the value of the risk. They like the 10.5. Is it a consequence that there's not other 10.5s in the market? Probably to some extent. But, we think it's very popular.
We think it's a very good security. We think HealthScope have created a lot of value since private equity have owned it, and they've developed a lot of assets. The diversification argument here, I think, is quite relevant, that you have some diversification away from banks and financials and those sorts of things to healthcare. And if you look at the equity market, most of the healthcare stocks are trading on quite high multiples. With an ageing population, we really like the security.
I like the idea of investing into the ageing population. I think that's a good thing to do, to be able to provide, to be the banker to that sector is a really good thing. I think ultimately it's a good social thing as well, because there's nothing worse than when you go into this sector and you say, well, we can't build the houses, we can't build the care, we can't provide, and that's where all the people are. It just seems to make some sense, but it's a very high coupon, Peter, which is clearly a good thing to get, but at the same time, you need to know your risks, you need to know whether it's appropriate for your portfolio, and you need to know whether Westpac actually has any, because they might have all sold them.
Not sure.
We have an email. Next email from Peter says, if the RBA lowers interest rates, do corporate bonds automatically go up in value immediately? Do you want to take that one?
Well, if they're fixed rate, they should.
Yep.
But if they're floating rate, then they shouldn't.
Yeah. So there's an array of different bonds. The thing for the viewers to be aware of is there's fixed, there's floating, there's inflation, and we speak a lot about the inflation-linked bonds. We think inflation's a big driver in everyone's life, and so they should have it in all their portfolios. But if interest rate movements go around, if they go down and you have a fixed rate bond, the value of the fixed rate gets lower. We just spoke to Peter about 10.5%. If interest rates go down to 2%, everyone really wants that 10.5 a lot more, don't they?
Yeah, I think the only point to add there is really around the credit of the underlying issuer of the bond, and so all other things being equal, if the bond, if interest rates go down, then a fixed rate bond like a Healthscope, as you say, should go up in value. But if there are issues with the credit of the issuer, then that may lead to a depression in the price. But leaving that aside, a fixed rate bond should go up in value.
Can I just come back to I wanted to ask you some questions about third link. Picking a fund manager, how have you found that? In other words, do you use your experience from people you know and you're really comfortable with, and therefore that's a great way to do it? Or is a young guy knocking on the door, hello Chris, I've got this great idea, we're going to buy X. How do you filter this?
Okay, well, a lot of it is experience, which you can't always get out of a textbook. When you read prospectuses, PDSs on equity funds, they'll always have a line somewhere there that says past performances is no indication of the future.
Yeah.
Well, I have the exact opposite view. Past performance and the snail trail that leads, so to speak, the thumbprints that leads, tells me a lot about a manager. So when I'm choosing managers, some of them are ones I've followed for many years, so I'm extremely familiar. Others I'll be less familiar. I'll be looking at talking to them, seeing if they explain themselves right, watching their behaviour, seeing what when their portfolios go down, why they've gone down, does it make sense given what they say. The thing I'm most interested though, which is a little different to other people who might mix managers together, I really don't care whether a manager is a growth manager, a value manager, a small cap, a large cap or whatever.
You want a return manager?
I want a return manager, that's exactly right. But the return I'm seeking is over rolling 5-year periods. So I say I'm looking for managers I think can get somewhere between 2 and 4% per annum after fees over rolling 5-year periods. Now if they go through a couple of years of poor returns, that doesn't faze me, because even the best managers have down periods and different conditions suit different managers. And so that's really, I'm a little unconventional in that way. I also like managers, when you're combining a number of managers together, I like managers who've got fairly concentrated portfolios.
Oh yeah, okay.
Because I don't need thousands of stocks in aggregate.
Yeah, they don't need to buy a whole index and say, look, I've got it, I've got everything.
That's right.
You know, you need to think that they know the company and they know the value of that individual company.
Yeah.
In terms of, with Mason Stevens, you're more about the transparency and the direct, so your customers are coming to you and you're trying to give them access to direct, either whether it be equities or fixed income, or you also do some options as well, don't you?
Yeah, I think we take an approach where we certainly do offer managed or unitised product, but we do look to allow that clients to own the assets directly, and really with the benefit of that transparency you can see how those assets perform. You can see the coupon that you receive if it's a bond, you can see the dividend you received if it's a share, the franking on that and so forth. And then we look to try and enhance that return in some instances or mitigate that risk by using equity options, and they're listed on the exchange. So yeah, we like the idea of transparency certainly, and we have a system and infrastructure that can show that. But we do generally also use unitised or managed funds as well.
One of the things I think is the clients are always now wanting to see what their performance is, whether that just be a consequence of how the equity market now treats you. You can click on and get a computer, but I think part of the evolution and part of the businesses I think will do very well are things like Iris and things that can provide you with a download straight away, take it to the accountant. It's cheaper because you've got all the numbers available. But do you think that's a growth in what customers want?
Well, I think that's what they should demand, really. I don't think that you know, given the technology that we have today, clients should be able to access all of the information relating to their accounts, and it should be produced for them competitively in terms of cost, and it should make the experience of going to their accountant a lot easier.
Yeah. Before we went to the break, I wanted to talk about the infrastructure bonds and the speed round, and so what I've done is I've created a portfolio, a bond portfolio. So if we can bring up that graph to have a look at the bond portfolio. These were the bonds that I was talking about, and it's the same as what you were saying. It's how customers can look at it. So we have an array of maturity dates. Essentially, the yield of maturity is the fourth column along, and then you have the running yield. So what I was trying to do was get something over 5% for the yield of maturity, and some of those returns, I think that infrastructure with Southern Cross Airports at close to 7% is a really nice return for, basically they're all senior debt. And I think that really helps people in terms of volatility around earnings. They're quite nice assets. And they're all infrastructure. GEM is the TAFE buildings up in Queensland, 5 TAFE buildings. Praco is the defence housing. We've spoken about that one. Dalrymple Bay is a coal loader. This one is a floating rate note where we're expecting the benefit to become at the end when it matures. And Southern Cross Airports is the very complex, as we've said. I don't think it's that complex anymore. It's inflation, and it's a margin over the inflation rate. So I think they're quite nice portfolios. I think it's easy to try and get to them now as well. You just need to take the time to go and do a bit of research. Now, the other question I wanted to talk to you about was philanthropy. You're moving into the philanthropy in terms of, you were saying to me, if people wanted to be philanthropic and they had money, it's hard to work out how to do it. We're going more to the American program of philanthropy.
Yeah, well, look, another business I'm involved with is called Australian Philanthropic Services, and what we do is set up what's called structured giving vehicles. So for people who are quite serious about ongoing giving and want to do it in perhaps a better structure than just giving money when someone knocks at the door, you can put money into you can set up things called private ancillary funds. But to answer your question, yeah, giving in Australia, I think, certainly amongst high net worth individuals, is becoming more structured and more thoughtful, and that is, following the American way. But that's not, just because we like being copycat. America's been around for a lot longer. The wealth is a lot older. Philanthropy is ingrained in society from the days of the big industrialists who made a lot of money and it left a lot in foundations, and indeed all the major universities have massive foundations. So people think about philanthropy in a much more considered way.
The chap that did the ETFs that donated the money to the Australian National University, he was making the point it was much easier in the UK. That they've created the structure. Is that something you've noticed, that it's hard to create these structures, or are you saying the envelope that you've created makes it easier for people?
Well, this type of structured vehicle I mentioned a second ago called a private ancillary fund, and there's also something called a public ancillary fund. These things, they are unknown, I think is the best way to say it. So there's not many people who know much about it. That's why I created a firm that's an expert in establishing and administering these things. So we think over time people will get to understand them more. A bit like a self-managed super fund was not a known term about 20 years ago. Now everybody knows about them. And I think it's just an evolution.
Moving into that market. As a consequence of our portfolio, we've got an email from Kyle from Manly, and Kyle asked, what is the difference between running yield and yield to maturity? And I like to think of it as an equity conversion. So the running yield is your dividend, and your yield to maturity is the return you get at a predetermined sale price. So I'm going to sell the share at $100 at par, and I think that's the easiest way for customers to understand it. That's the yield you'll get at the end, and the running yield's the dividend you're going to get. Any other thoughts on that?
Well, the running yield is the coupon divided by the purchase price. So if the coupon's 5% and the purchase price is $100, then it's a 5% running yield, and it'll be a 5% yield to maturity as well. But if you buy the instrument for more than $100, then your running yield will be lower, and your yield to maturity will also be lower. And if you buy it for less, then the reverse will be the case. So.
And the thing with bonds is that they pay them out unless it's an inflation, they pay them out at par, which is $100, issued at $100. And the issuer doesn't care who owns them, he just wants to pay out the $100 at the end of the maturity, and he pays it out, and he's quite happy with that.
Correct.
When you talk to clients, what do you think they're expecting in terms of return? Do you think, is 6% the number, or are the clients saying, I need to get 7? Has there been a movement around that with the cash rates coming lower?
There's been a very large movement, I think, and we've seen it with the sentiment that we've seen change so dramatically in the course of the last 12 months. I think, on balance, 12 months ago, clients, certainly around that June period, were more interested in capital preservation. So a nominal return wasn't really in their mind. It was more around protecting their capital and then looking to achieve a return or a coupon or interest on top of that. And they felt comfortable, given where term deposit rates were, that they could get 5-6% on those deposits. Now it's changed quite dramatically, I think, generally, in that clients are far more willing to go up the risk curve, and they are trying to target those high single-digit type returns, but they're prepared to take a lot more risk to achieve them.
Chris, we'll talk about some of these risks after the break. We must go to a break. Thank you. We'll see you soon.
What's the best protection for dogs from fleas and deadly ticks?
Advantix.
It kills fleas and ticks. It repels irritating mozzies and other nasties. And it's water resistant. Advantix. Now that's advanced pet care.
The CommSec app gives you more than one view of the market all day, every day, allowing you to manage your investment portfolio on the go. With access to live quotes, charting, watch lists, live market indices and exchange rates, you'll have all the tools to buy and sell shares right at your fingertips. Featuring smarter navigation, improved performance and access to multiple daily market updates. Visit the App Store or Google Play Store and download the CommSec app today and make every second count.
This is for the part of you that worries, does the maths, calculates, that contemplates important things like your super, but picks 1:21 a.m. to do it. Sleep easy. With ING Direct Living Super, you can choose your investments, so you decide where your money goes and when. You're in control. Spend your life well with ING Direct Living Super.
If you love adventure, you can't beat a self-drive holiday along Explorer's Way between Adelaide and Darwin. See it all in style in a Brits four-wheel drive camper. Book now and get 40% off rental at adventurealltheway.com.au. Start your adventure now.
Welcome back to tonight's course of the Chris and Chris Show with my panel. I have Chris Alcott from Mason Stevens and Chris Cuff. Chris is in Third Link. He is Cuff Links, and we've got the philanthropic performance. So we have an email starting off our segment. The email is from Jeff in Brisbane, and Brisbane he said, "Have I missed the boat on bonds?" I don't think so. Jeff, I think the boat's quite all right. I think it's quite balanced, it's robust, and it'll go further. What are you telling clients who've said, look, bonds are expensive? You know, what do you tell them?
Well, I think there's two things. I think one is duration. So I think at the shorter end of the curve, so shorter dated maturities, I think if the bond market falls, then your potential losses would be limited, and you could replace that capital at potentially higher returns. So I think how you construct your portfolio is quite relevant to that. I think secondly, looking at different types of bonds. So there's bonds that are easy to access, the hybrids in the market and so forth, but things like the asset-backed securities, the infrastructure securities,
yeah, they're all available.
Those yields and those returns are still holding up. So I think looking sort of more outside the square, there are opportunities in the bond market.
Yeah, I was going to say, that's the thing that surprises me a lot. I think people only think, when they think the word bonds, as a very small universe.
They do.
This whole unlisted universe of securities which are traded over the market. Your firm trades them. Most people don't know about those, and there's very good securities there that they should be looking at.
And globally, that's what people do. You know, globally, that's how people trade. They trade over the counter. They buy their bonds, and they make it part of their portfolio.
Yeah. Well, particularly if you can buy them in smaller parcels. I mean, it wasn't that long ago that you couldn't buy an over-the-counter bond unless you had $500,000 minimum for one security.
Yeah.
Now, because of the way people do things these days, they're splitting parcels, so you can buy, over-the-counter securities with as little as $50,000, as you said earlier.
Clearly, there was no diversity in that. If you have $500,000, once you'd finally saved it and buy the one bond, that wasn't quite the answer on my diversity. CBA has gone from $100 billion to $112 billion in market cap in the space of about 6 weeks, so $12 billion. Now, I can tell you that when I talk to anyone at CBA, they love the joint. It's great. It's it's not even the fact that the new boss is a great boss, but they certainly think he's a great boss, and they certainly have the morale there is really, the engagement is fantastic. And I wouldn't say the same of the other banks. I don't think that's universally with the banks, but $112 billion is a lot of cash. So I guess the question is, in my view, the bed has been made with the senior echelons of the bank to say, we know why the share price is where it is. It's because of the dividends. It's not just because you think we're great. I think Basel III is going to have stabilisers to be able to have credit growth. I think it's going to be hard. So I think there'll be some tough decisions in the management of the bank. What's your thoughts on not so much the CBA, but in terms of everyone's buying these banks for their dividends? Are we happy with all that? Is that all very fine? How would you respond, Chris?
Well, look, the first thing is I think people en masse are thinking of bank dividends as equivalent to an interest rate on a term deposit or something like that, or what you get in the bank, and we talked about that earlier. It's a completely different security, and we are at a point in time, though, which is not unique, but it's certainly in a minority where dividend yields are significantly higher, grossed up dividend yields have been significantly higher than interest rates.
Yeah.
So, of course, people start to sort of substitute it in their mind. What we do know, too, is pre the global financial crisis, the banks were writing very good business. Credit growth was extremely strong. They had a lot of staff. And if you like, they became a little bit fat in their cost ratios. So post the GFC, with the turn down in credit growth, and the banks have had plenty to work with to trim the fat and keep their ratios right. But as sure as night and day, bank dividend yields won't be higher than interest rates forever, and banks do have long periods in history where they haven't performed very well either.
Yep.
So just be careful.
Yep. What do you think?
Yeah, look, I think the other thing to consider when you're trying to value a company is not just the dividend that it's paying at this point in time, but also the price to earnings ratio, the book value, and certainly the success of the Australian banks and the longer term performance that they've delivered shareholders has meant that the markets are now prepared to pay quite high premiums for the book value of those assets. So the price to earnings ratio is certainly in historic sort of sense quite high, and the price to book is very high.
I spoke to a really well-regarded family office today, and I said, what are your comfort levels? He said, I'm very happy for the rally, but I'm not going to put any more money at work. I don't want to enter it right now. And I always feel real concern when the money that I hear coming back into the market is that retail number, that retail money that mums and dads are buying. And it always makes me a bit nervous, because I just think it's okay to have picked that rally early, but it's very hard to pick that timing after that rally. It becomes very tricky, and everyone is encouraging buy-in. This will rally for years, so you should get onto it. Switching a little bit, I want to talk about longevity. I think one of the keys to all of this is your entry price is subject to how long you'll be around to take advantage of that. One of our great concerns is that people don't invest long enough. They don't invest for the duration. They look to retire and think, I won't invest for anything longer than 5 years. I mean, what's your view on the longevity question around performance and returns?
Well, first of all, the whole longevity issue is very topical amongst the professional markets these days. We know, on average, a fantastic statistic is someone born after the year 2000 will, on average, reach 100. The first person to reach 150 is now alive. Of course, they haven't yet reached 150,
yeah.
But we're dealing with a period of time where, not that long ago, through the compulsory superannuation system, I think the architects of that were looking to plan for people to go from 60 to 80-ish.
Yeah.
And now there's a whole new second wave of how you get people from 80 to 100, and clearly the existing systems aren't going to cope with it. But when you start to look at assets that support the long term, you know, that's a real issue because, you know, if you're 60, you want something that's going to last you more than 5 years, probably, unless you've built up such a lump sum that you can buy an annuity that will see you, you know, till you're over the try line.
And the point is that you're still having to leave work at the same time, so you're still living longer. It's just that everyone still retires at 65, and it's not as if there's job offers for a 65-year-old coming to be an actuary. It's not happening that way, or a plumber or whatever. We have a caller. We're getting at the end of the show, but it's Tom from New South Wales, on the south coast. Hello, Tom.
That's it. Hi. How you going? My question is the value of bonds. I think it is probably the only way of protecting your share portfolio. If your share portfolio is under stress, what do you do? If you've got bonds to, I think you should be carrying both bonds and shares.
That's Tom, I couldn't agree more. I think there's a little bit of irony about our Friday night show. It's bonds versus equities. The actual fact is you need both. I mean, clearly all the good professionals will tell you that you should have a balanced portfolio, and it could be 50-50, it could be 60-40, 70-30 in one manner, depending on what you can do at your point in time, where you are in the cycle. But the reality is that we've never really had enough bonds anyway, so it's just buy more bonds, really. I mean, I don't know why I said that at FIIG, but anyway, buy more bonds, that'd be a good idea. We're going to have to wrap it up, I think. The one thing I wanted to ask you is the sequester, the United States, is it all working out? You know, we think, when I saw the sequester and saw what they were going to do with the tax receipts at the end of the year and the fact that these people were losing jobs, I'm very surprised the market continues to rally, just ignores it. I mean, what is your thoughts on the sequester?
They're focused on the money printing. I think they're not focused on the sequester. I think that's where we sit at this point in time. They may get more focused on fiscal sort of austerity, you know, in the near future. Who knows?
Chris?
I think I could say I have no idea, but what I would say is the US has an amazing ability to continually reinvent itself, even in tough times. And, you know, all that's happened over there with what's happening with energy in particular, I wouldn't underestimate the US about to go through a very strong phase in history again.
That energy is a very big question. But we'll be covering that next week, because we do have, that's all the time we have for today for the Chris and Chris show. We thank you so much for coming on. The guests have been great, the questions have been fantastic, the emails have been quite good. So we're very happy with all the performance. Next week we're going to have John Pearce, who is the Chief Investment Officer for UniSuper, and we have Dan Eakins from Deutsche Bank talking to us about REITs. So all the best and have a great Friday night. Until next time, I'm Mark Todd from FIIG.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.